Welcome to vTalkInsight, Risk Sentiment Daily for March 27, 2026. After a sharp equity sell-off and another spike in volatility, today is all about how the oil shock and geopolitics are forcing portfolios back into defensive risk-off mode. Risk tone has swung decisively back into defensive risk-off territory. The S&P 500 fell around 1.75%, while volatility pushed into the high 20s, signaling a broad de-risking across public markets. That marks a clear break from the more cautiously risk-on bias we saw only a day ago, when equities were grinding higher despite elevated volatility. Now, the message from positioning is different. Market participants are cutting risk across interest rates, equities, and credit as the Middle East conflict escalates and oil reprices higher. In the UK and parts of Europe, sentiment is notably cautious, with slower decision-making, reduced venture flows, and businesses reporting squeezed margins from energy, tax, and labor costs. Despite this shift, many decision-makers still do not see the preconditions for a classic systemic crisis. U.S. banks are described as in better health than before the global financial crisis. The official sector retains room to act, and some committees judge the probability of cascading failures as relatively low. At the same time, significant cash remains on the sidelines and contingency planning is center stage, suggesting a market that is defensive, highly uncertain, but still poised to move quickly once the geopolitical and energy picture becomes clearer. The dominant bearish force today is the Middle East energy shock and geopolitics. Recent U.S. airstrikes on Iran, additional military deployments, and a looming ultimatum have pushed crude toward its largest monthly gain since the early 1990s and triggered sharp equity declines. Tech shares are under particular pressure, while European bourses and emerging markets are firmly in risk-off mode as investors reassess both growth and inflation paths. Energy markets are fixated on the Strait of Hormuz. Iran's demands for sovereignty and the risk of persistent fees on shipping raise the prospect of lasting disruption at a choke point that major economies and Gulf producers simply cannot accept. Multiple scenarios now put oil at $150 a barrel if the conflict persists, with some officials modeling stress cases closer to $200 and estimates of $120 to $160 even without a worst-case hit to infrastructure. This shock is creating clear winners and losers. Energy importing emerging markets face acute stagflation risks as weaker currencies and higher fuel costs erode real incomes, while oil exporting countries such as Colombia, Ecuador, Angola, and Nigeria benefit from stronger buffers and prior monetary tightening. On the policy front, G7 governments are prioritizing de-escalation and safe passage through Hormuz, and there is talk of coordinated action, including potential use of strategic reserves to stabilize energy and fertilizer supply chains. Yet diplomatic efforts remain stalled. Iran has rejected recent proposals, and the risk of renewed escalation keeps the near-term skewed to more volatility and further downside for risk assets. The second key bearish driver is stagflation risk and policy constraints. Rising oil and gas prices are lifting energy and transportation costs, compressing manufacturers' margins and forcing firms, especially in the UK, to juggle higher taxes, labor costs, and tighter financial conditions. In energy importing regions, wholesale gas and power prices are climbing, threatening both investment and profits and reinforcing a backdrop of weak growth but stubborn, cost-driven inflation. Central banks are caught in a difficult trade-off. Supply-driven inflation from energy complicates any shift toward easier policy, even as data show pockets of economic weakness and financial stress, particularly for lower-income consumers facing rising delinquencies and unaffordability. In the U.S., the resilience of activity despite aggressive rate hikes suggests the neutral rate may be higher than previously assumed, reducing the likelihood of quick, growth-friendly cuts and raising the risk that any eventual easing is prompted by deterioration, not strength. Market signals reflect this tension. Current U.S. Treasury yields around 4.3 to 4.4% are seen as fair given large fiscal deficits, with scope for more long and selling if deficit worries persist, while 10-year UK gilts near 5% constrain fiscal space and invite market scrutiny. Analysts point to a sustained oil price above $150 as a rough threshold for a global recession, especially once higher natural gas and fertilizer prices ripple through manufacturing and food supply. Gold, meanwhile, is under pressure despite the conflict as a stronger dollar, higher yields, and even potential central bank sales erode its appeal, underscoring how few easy hedges exist in this environment. Against this macro backdrop, private asset valuation and liquidity risks are moving closer to the foreground. Private credit has exploded from roughly $40 billion before the financial crisis to nearly $1 trillion today, becoming a central channel of capital formation as bank lending has retreated. That growth has come with increasing questions about how assets are marked in illiquid markets, where valuations often rely on models or comparables rather than arm's-length transactions. Recent developments highlight those concerns. Ares Management's private credit fund just posted its steepest monthly loss on record, and several funds have imposed withdrawal limits, signaling stress and raising doubts about how easily investors can exit even in relatively benign market conditions. At the same time, both private credit and private equity managers are holding substantial unsold inventory, with commentators warning that a future market reckoning could be triggered by catalysts such as asset write-downs, technology failures, or renewed commodity price spikes. For now, this looks more like a valuation and liquidity problem than a systemic banking crisis. Some industry leaders report no meaningful rise in portfolio defaults, and banking systems, especially in the U.S., are described as materially stronger than in 2008, with sizable loan value cushions and more resilient balance sheets. Even so, the combination of accumulated risk after a long crisis-free period and opaque pricing means that any shock could produce non-linear repricing in private assets, with implications for institutional portfolios heavily exposed to alternative strategies. On the bullish side, AI-driven growth and productivity gains remain a powerful counterweight to today's macro gloom. The current technology cycle is fundamentally reshaping software and services, with expectations that several new trillion-dollar companies could emerge from this wave. Major tech firms are committing unprecedented capital expenditure to secure their position in the evolving AI ecosystem, treating it as existential rather than optional. These investments are already feeding through to real economy signals. AI is shortening software development cycles and allowing established vendors to offer greater efficiency and value to industrial clients, while U.S. productivity gains from AI are expected to outpace other regions and, over time, support a structurally stronger dollar. China is also participating in this race, with exports of AI-related goods growing around 6% year-on-year and accounting for a large share of global AI exports, and its labs are seen as only months behind U.S. peers, underscoring a genuinely global innovation contest. The path will not be smooth. Investor enthusiasm in some AI-linked sectors, particularly data centers, already resembles past bubbles, and sudden innovations, such as Google's memory compression technology, have triggered sharp drawdowns in hardware names by challenging prior demand assumptions. Yet the broader message is that, beyond today's volatility, AI and digital infrastructure investment remain a durable growth pillar that can help offset some of the drag from higher energy and tighter financial conditions. A second supportive driver is private credit and banking system resilience. The secular decline in traditional bank lending since the financial crisis has pushed more capital formation into private pools, making private credit essential to financing growth as both government and bank balance sheets face constraints. Within this space, demand remains strong, spreads are described as healthy, and covenant quality is generally robust, with concerns about direct lending concentrated in a relatively small subsegment rather than the whole complex. Crucially, this shift has not left banks in obviously fragile shape. U.S. banks are seen as better capitalized than before 2008, with significant cushions against potential losses on loans to non-financial firms, and policymakers have more room to respond to shocks because policy rates are well above zero. While performance issues in specific private credit funds and lingering liquidity questions merit close attention, The prevailing view in these insights is that systemic banking risk is lower than in past crises, which in turn reduces the probability that today's volatility morphs into a full-scale financial meltdown. The final bullish factor is the significant cash on the sidelines for a potential post-shock rally. After a series of geopolitical and macro surprises, many investors have pulled back, reducing risk exposure in rates, equities, and credit, and in some cases waiting explicitly for clearer resolution of the Middle East conflict before adding to risk assets. In venture and private markets, particularly in the UK, this caution shows up as slower decision-making and a higher bar for funding approvals. Yet that conservatism also creates upside optionality. With substantial liquidity parked on the sidelines, several observers expect that once geopolitical uncertainty and the oil shock begin to fade, markets could see a powerful rebound as investors move quickly to deploy capital. The key risk is timing. Entering too early, while conflict and energy risks remain unresolved, could expose portfolios to further downside, but waiting too long raises the chance of having to chase a rapid recovery. To sum up, today's landscape is defined by defensive risk-off positioning driven above all by the Middle East energy shock and the stagflationary, policy-constrained backdrop that follows from it. Layered on top are mounting questions around private asset valuations and liquidity, even as banks and policymakers appear better placed than in past crises. Offsetting these headwinds, structural AI-driven productivity gains, the expanding role of private credit in funding the real economy, and large cash balances on the sidelines all point to meaningful upside once geopolitical and energy risks start to normalize. For now, the balance of risks argues for close attention to oil, inflation, and credit signals, alongside the pace of diplomatic progress in the Middle East. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.